We are on chapter 11 this week. So last week we skipped ahead to chapters 15 and 16. And the reason for that is just so that you could make sure that you knew that information going into preparing your teamwork for the financial statement analysis. That way you have that information you need. And actually, chapter 16, the financial statement analysis stuff is going to go great with this chapter because we do learn a few ratios, and now you know all about ratios, so this is great. So responsibility accounting systems. Um, uh, um, Typically, you'll see something called an RC. So where you work, probably have RCs, and they probably have an account number of their own. And when you see accounting done, it's not done not just for cash, but for the cash affiliated with an RC. So instead of just account number 11,000, it'll have RC 2122, account number 1000. That's the cash for that responsibility center. So RCs is what we're talking about. Why do we have these RCs? Well, companies are big, right? So we have to make sure that people at different levels of the organization and running different departments and different divisions, we have to make sure that they're doing what they should be doing, right? So the CEO, the board of directors, the people up towards the top, they can come up with strategies, they can come up with the strategic plans, but they're not actually going to exercise those plans. They're not the ones who make them become reality. It's the management out there that's doing it. So in order to ensure the managers are doing what they're supposed to be doing, they're assigned to RCs, responsibility centers. And that way, their performance can be tracked. All right. So this chapter is about how can we track the performance of different responsibility centers and ensure they're doing what we want. And what are they doing, right? What are they reporting out to us? What does it mean? Right. So that's what this chapter is about. There are lots of different kinds of reporting centers. So obviously, when you have big organizations, you have to have this decentralization. One person can't be in charge of everything. All right. So the top management gets to focus on our strategy and our relations to other organizations and within the industry and uh, within the economy in general. So people who are higher up can focus on higher up questions, and people who are further down the organizational structure can focus on their immediate needs right there, right? Lower level managers can respond more quickly. You've got more information about what's actually going on in your area. And if you're a manager who gets to make decisions and run your responsibility center, well, that's better. You have some authority. You kind of don't feel like you're just a cog. You're actually someone who can make decisions. So it's a good strategy. Some disadvantages are, when you've got all these managers at all these different responsibility centers, they may not be able to coordinate across all their different layers and levels, right? They can focus on their responsibility center, but how it fits in the big picture may escape some of these folks, right? And something one division is doing really well that might apply to another part of the organization may not get there, right? Because things have to kind of go up the chain of command and then down to a different center. So there can be some disadvantages as well. So under this responsibility center method of accounting, managers are held responsible for items they can control. Now, not every manager can control everything, right? But when you're in charge of an organization and you can control something within that part of that organization, they're going to ask you maybe to be responsible for it in a responsibility center accounting scenario, right? And typically we think of them as either cost centers, profit centers, or investment centers. For a long time, I really didn't realize there's anything besides a cost center because that's all I ever worked in, doing accounting type things. But there certainly are profit and investment centers. So a cost center is a manager who has control over costs, but not revenues or investment funds. So it's pretty easy to imagine the factory manager, and of course they can manage the costs within their little factory. They can't maybe manage costs of raw materials, but they can manage labor costs and utility costs and things within there. But certainly they can't be responsible for sales, right? And they don't have responsibility for investments. Maybe they do, but if they're a cost center, they don't. So they don't get to buy their own robots to put the cars together, things like that. So cost center, yeah, you have control over costs, right? And not any other things. A profit center can make profits, right? So they can control revenues and costs. So think of something like an individual store, and so the store manager can control the sales, and they can also control the costs within the store, right? So they don't have much control over the investments, though, right? So are they going to have to sell out of this store with these fixtures, or could they maybe get a new store? I mean, the manager of a Walmart doesn't get to decide where their Walmart is, right? But they do just get to decide things like, oh, I'm going to put these items on sale, not these items. I'm going to have people work these shifts. I'm going to put this ad in the circular this week, things like that. An investment center, so the manager has control over everything. So you can imagine you're the head of a division, and so everything underneath there belongs to you, including the investments in things like where the buildings go and who buys that. All right, so if you want people to do something the way you want it done in an organization, what you do is you pay them, right? You pay people to do things a certain way, and people will do what you pay them to do. So if you say, I want you to make a certain return on investment for me in your investment center, that's what they shoot for, right? So there are many different ways people are compensated that tries to get them to do certain things for the organization, right? So think of like a sales commission to a salesperson. You want them selling as much product as possible. Say the more you sell, the more we're going to pay you, right? Well, it's kind of the same idea with responsibility centers. The better you run your responsibility center, in other words, the better you hold costs in place, the better you increase profits, right? The better you do what it is we want you to do in your center, the more we're going to give you a bonus based on some number, like ROI. Sorry, I said ROA. ROI. So let's talk about ROI, which we already talked about last chapter. It hasn't changed. All right. And the only difference is because we're talking about responsibility centers. So in the last chapter, we looked at financial statements, right? So if you look at an annual financial statement, right, net operating income divided by average operating assets for the organization as a whole, right, and that set of financial statements. Whereas with an RC, you could be looking at with the profit center, responsibility center, or investment center, responsibility center. I should say investment center, responsibility center. You could look at just that center's ROI, right? So, but just so you understand, it's still the same thing. So we got net operating income divided by average operating assets. That's return on investment. So you get these two numbers, and it would turn that into a ratio, and your organization could pick a number they would like to see. We would like to see a return on investment of 10%. And if you don't make that, you don't get your bonus, right? So something like that. So first of all, we have to talk about what's an asset, right? So obviously these investments, this return on that we want on our investment, right? Our investments in this case are average operating assets, right? Average operating assets. So we've already learned last chapter that average, we take beginning plus ending divided by 2, right? But what number do we use for the assets? Well, we're going to use what's called net book value. All right, net book value. All right, so when we do accounting for any investment asset, not any investment asset, because you can invest in stocks that you have to revalue. All right, but let's say something like that, an investment center, right? So the Walmart store or the Ford factory, the Ford division of Ford Motor Company. So you're the VP of Ford and you're an investment center, and so you have control over the investments, the revenue and the costs, right? So what is the investment part? If that's our return on investment, what's the investment part? Well, the investments are the net book value of our investments, like factories and the robots that build the cars, the investments. So the thing about investments is when we put them on the books, right, when we start accounting for them, we put them down at historical cost, right? Acquisition cost, they're calling it here. Historical. So let's say something cost $1 million, right? So it cost $1 million when we bought it, right? And then each month or each year, each accounting period, we take some depreciation and we debit depreciation expense and we credit the contra asset accumulated depreciation, right? So we got this accumulated depreciation account that accumulates every accounting period. It grows and grows and grows, right? So you subtract whatever's in there, and let's say at this point it's 200,000, right? We depreciate at 50,000 a year, and 4 years have gone by. So there we go. So now the net book value is cost minus accumulated depreciation, 800,000. All right. So that's when we talk about investment assets for this point, return on investment. So we're talking about what are our assets? It's historic cost or acquisition cost minus accumulated depreciation equals net book value. So don't forget we're taking the accumulated depreciation out. All right. So ways of looking at ROI, right? ROI is net operating income divided by average operating assets, right? So, and in this chapter, I think they just give you the number of operating assets. They don't say here's beginning, here's ending, divide by 2. They just say, here's your operating assets. But remember, average, it is based on average because assets change over the course of a year, right? You'll get rid of some obsolete equipment and buy some new equipment. Things like that happen. So your ROI, return on investment, is net operating income divided by average operating assets. Another way people look at this, excuse me, sorry, is margin times turnover. And if you look at this, right, so margin is income divided by sales, and turnover is asset turnover, gross margin, asset turnover, sales divided by operating assets, right? So if you take margin times turnover, that's your ROI. So we're really caring about, when we look at ROI, we're bringing these other numbers into play when you think about, right? So when you turn multiple numbers into a ratio, that's letting you evaluate multiple numbers using just one number, right? And of course, as you look at this, it should be pretty obvious why ROI is equal to margin times turnover, because if you look at this, margin is just net operating income divided by sales. Turnover is sales divided by average operating income. Well, here's your denominator, here's your numerator. They're both sales, they cancel out, right? So then margin times turnover is equal to ROI, because that leaves you with net operating income over average operating assets. So ROI, depending on what numbers you're wanting to look at and focus on, you can either call it ROI equals this or ROI equals margin times turnover. All right, so here you go. Here's an example, right? So we have a company and their net operating income is 30,000. Their average operating assets is 200,000, right? And sales are 500,000 and operating expenses are 470,000. So what's our ROI? Well, ROI is net operating income divided by sales times sales divided by operating assets. So it's kind of like this, right? You do this first, then this, right? Parentheses first, right? Okay, so you do these two, then you multiply them, right? Or you could just take 30,000 divided by 200,000. All right, but we're looking at it as margin times turnover. So margin is 30,000 divided by 500,000. So that's equal to 6%. And 500,000 divided by 200,000 is 2.5. That's times 6% times 2.5 is equal to 15%. And of course, if we had gone back here and taken 30,000 divided by 200,000, that would be 15%, which you can tell by looking here, right? Leaves us this, right? 30,000 divided by 200,000. All right, so there you go. It's 15%. So the ROI for this organization, this part of the organization, is 15%. I don't know if they don't say if it's a responsibility, the company. So this is the whole company. It's not just one RC. All right. Now, here's where using this ROI as a way of getting people to do what you want comes into play, right? If you say you have to have an ROI of 15%, right? Or something thereabout, something like that. We expect an ROI of 15%, let's say, right? So now, because you are in charge of this investment center, and you can say, should I increase the assets? How will that make my ROI turn out? They pay me based on ROI. Do I want to do that? Right? So what you can do is, okay, so I have net operating income is 30, average operating assets is 200, right? So here's what's going to happen. That's gonna, if I spend 30,000, right, then my operating assets are going to increase to this 230,000, right? They were 200,000, right? So my income will increase by 50, right? My sales will increase by 35, operating expenses by 15. So here's basically our new set of numbers, right? So our old set of numbers, we were at 15%. Yay. All right. So here's a new thing we can do. Here's an investment, right? 30,000, and this is how it will change my numbers. Do I want to do that? Well, if I do that, right, now I've got 50,000 divided by 230,000, right? Or doing it based on margin. This is my margin. Margin is 9.35. Turnover, 2.33. 9.35 times 2.33 equal to 21.8. So that's better, right? So we would want to do that, right? I've increased my ROI from 15 to 20%. Now, here's a problem, all right? So if you pay somebody based on ROI, it's hard to know necessarily how to increase it, right? So any one manager may not know what opportunities there are for investments, right? You may have not control over certain costs, and as you saw here, there might be something that's profitable, but it decreases the ROI a little bit, but it's still going to be more profitable, and so they may reject things just right. So if you make your payments, if you make your bonuses or your salary or something based on like one single number, they're going to go for that, right? Whereas if you have a balanced scorecard, they can't put aside other factors and just focus on this one number, which is not what you want, right? So you can increase ROI, but have terrible customer service because you've laid off all the customer service people, right? That would not be good for the company in the long run or something, right? So simply increasing ROI is not generally an ultimate goal, right? You may want to have some kind of balanced scorecards, which I think we learn about in chapter 12. All right. So another thing we might look at is residual income, right? So you could have some minimum return, right? You could say we want you to make 15% ROI, and anything you make beyond that residual, that's good. We'll give you bonus based on that, right? So they don't just reject something that may slightly minimize the ROI or something, but still be profitable. So let's talk about residual income. What is it? Well, residual income is the net operating income minus average operating assets times this rate of return. So in other words, we're picking something, right? So if your company knows, well, we can invest in this and make 10%, we can invest in this and make 12%. We want to be making 15% with all our efforts, right? So they pick some required rate of return. And then they're saying, okay, so after we've looked at what you had to use, now we can see how we did. So, and whatever's left over, that's our residual income. So it's obviously easier to do with actual numbers. So here we've got the retail division of Zephyr. So we're just talking about the store part, the retailing part. All right, they have average assets of 100,000. They have to earn 20%, and we've earned 30,000. All right, so there's some numbers. What are we doing here? So we have to make 20,000, right? So 100,000. So we have to make our rate of return. So if we have 100,000 assets, 20% of 100,000 is 200,000. So what did we end up with? We made 30,000 minus the 20 that were required. So our residual is 10,000. Right? Easy, right? It encourages managers to make investments that would be rejected solely based on ROI, right? Because here, if our ROI is 20 and somebody comes along with something that would be 18 ROI, well, 18 ROI is still pretty good. And so by looking at residual income, we're maybe preserving that because we've made our minimum, right? All right. Let's do a couple little problems, kind you might have on your deal. Okay. So Redmond Awnings has a net operating income of 60,000, average operating assets of 300,000, required is 15. What's the ROI? Okay, so going back to ROI. So ROI is simply the income divided by operating assets, or as we learn, margin times turnover, but we're not gonna look at that. We're just, the only numbers we've got is these two, right? So 60,000 divided by 30,000 is 2 divided by 2, so 20%, right? So 20% is the ROI, right? Net operating income divided by average operating assets. All right, so what's another one? Redmond Awnings, a division of Wrap Up, has 60,000, operating assets 300, still the same. Evaluated on ROI, right? So we know back here that they are at 20,000. When they do this, they're making 20,000, 20%. I'm sorry. So based on ROI, do you want to invest another 100,000? That would give us 18,000. Well, I can see that this right here is 18%. So the answer is, oh, I'm sorry, it's 19.5. Well, that's this. There's an 18% return on this part. That's what I can see. But actually, the average. So when you take your 60,000 plus 18, that gives you 78,000. 300,000 plus 100,000 gives you 400,000. So 78,000 divided by 400,000 is 19.5, or in between the 20% and the 18%, 19.5. So if you do this, right, spend 100,000 to make 18,000 more, it lowered your ROI, right? So if like I had 20% ROI last year and I'm going to get a bonus based on 20%, I don't want to go to 19.5. It lowers my bonus, even though it would have made the company 18,000, which is still a good return, right? They wouldn't want to do that. All right. Now, the required rate of return is 15%, right? Would you make an investment of 100,000 to get 18,000 a year? Right. Well, I already said you can just look at that and go, oh, that generates 18%, right? So 18,000 divided by 100,000 is 18%. You can tell that by looking. So I would have some residual income from that. So yes, I would want to do that, right? What's the residual income? And so here we are looking at that. Okay, Redmond Awnings has a net operating income of 60,000. Average operating assets required rate of return is 15. What's the residual income? Well, we take the 15% of 300,000, right? 15 times 3 is 45. So that's 45,000. All right, so 45,000. 60 minus 45,000 leaves us with 15,000. Right? So there's your residual income on that 60. All right, so our initial scenario, 60,000, assets of 300,000, 15,000. What if we make an additional investment that would generate 18,000 per year, right? Well, that's going to change our net operating income. It's going to change, and I can already tell by looking at this that that's more than 15%, so it would add, right? So I'm just going to say yes. Let's look at the numbers. So we'd go from 60,000 to 78. 15% of 400,000 is 60, right? So the residual income is 18, and that's 3,000 more residual income than here, right? So that seems like a good idea. We should do that. Okay, so people do what you pay them to do. So using just one measure like ROI may not be the best idea. And we are going to talk about things like balanced scorecards and things in the next chapter. So just keep in mind, this chapter, we're talking about responsibility centers and looking at how they interact and how what they do impacts the company. And just keeping in mind, people do what you pay them to do. So I need to make sure I'm selecting my performance measures well, right? All right, so we're going to stop here and we'll come back and talk about transfer pricing in the next video.